Welcome to Caribbean Business Review, where insight meets impact. We bring you economic and financial updates, sharp statistical breakdowns, and data-driven insights on the forces shaping the region. Smart analysis, bold ideas, real Caribbean intelligence. This is CBR. Welcome to episode 14 of season 2 of the Caribbean Business Review. I'm Joseph Cox. Now, thank you as always for your continued support across our digital platforms and on MKR Radio. This week, our special guest, Dr. Delreo Newman, Chairman of the Caribbean Association of National Telecommunication Organizations, CANTO, as we examine the Caribbean's growing telecoms crisis, from the looming shutdown of the 2G and 3G networks to widening 5G gaps and rising costs. And in today's CBR briefing, we analyze the future of cable in the Caribbean, technology shocks, fiscal constraints, and a coming churn crisis where customers steadily cut the cord, cancel subscriptions, and don't come back. A shift that could fundamentally reshape the region's cable industry. Our new midweek series, CBR Intelligence Notes, is also live, delivering deeper, data-driven insights every Wednesday. Look out for the next edition. But before we begin today's briefing, we need to address a widespread narrative. The winter tourism season traditionally commences on December 15, yet the Caribbean enters this peak period with widening structural weaknesses. While Jamaica has managed to stay competitive and the Bahamas has partially insulated itself through scale and branding, much of the wider CARICOM region has steadily lost ground to destinations such as the Dominican Republic and Puerto Rico. Those markets have sprinted ahead with modern hotel stock, upgraded transport infrastructure, diversified attractions, and visitors' experiences built for today's traveler. And the stakes here are not theoretical. Across much of the English-speaking Caribbean, the tourism product remains overwhelmingly anchored in sun, sea, and sand, with few clearly defined national and sub-regional identifiers that distinguish one destination from another. This lack of differentiation has left many territories competing on price rather than value, an increasingly dangerous position in a global market where travelers are actually price-sensitive and willing to substitute destinations when costs rise. This strategic inertia is particularly risky given that tourism accounts for anywhere between 7 and as much as 90% of GDP across the region, depending on the country's economic structure. Yet governments continue to layer soaring taxes on air travel and hotel stays, especially within the Caribbean itself, as though demand were immune to price signals. As economist Tom Compton-Bourne recently cautioned, visitors simply choose cheaper, more efficient destinations when costs escalate. At the same time, the region has been slow to innovate beyond the traditional tourism model, underinvesting in service quality, ecotourism infrastructure, language skills, and digitally enabled experiences that could deepen value and resilience. Without urgent reform of outdated fiscal approaches and a deliberate push towards differentiated experience-driven tourism, the Caribbean risks remaining operationally open for winter, but strategically unprepared for the next phase of global tourism competition. Now, with that clarity in hand, let's turn to the stories we are tracking this hour in Market Watch and Global Pulse. Coming up in the Market Watch, Guyana launches $20 million white sugar refinery. Jamaica launches Climate Guard parametric microinsurance for vulnerable households. And Bermuda's electricity rates to fall 7.6% in January. Then in Global Pulse, China's trade surplus tops $1 trillion. Fed cuts rates to 3.6% but signals long pause. And Canada swings to $153 million trade surplus. All that and more this hour on Market Watch and Global Pulse. Coming up next, it's a CBR briefing. Welcome to the CBR briefing. I'm Joseph Cox. Today we examine an issue now reaching a critical threshold across the region. the future of cable television in the Caribbean, and the real risk of losing access to major U.S. broadcast networks. Now, this is not simply a technology story. It's a story about timing, financial stress, fiscal limits, and what happens when a mandatory upgrade collides with climate vulnerability. The United States is accelerating its transition to ATSC 3.0, a next-generation broadcast standard. For Caribbean cable providers, this means mandatory investment in new receivers, DRM-compatible equipment, and renegotiated broadcast rights, all upfront, all non-optional, and with no immediate revenue upside. The stakes are high. Failure to adapt risks losing access to the core U.S. networks, NBC, ABC, CBS, Fox, and PBS, which have long anchored cable subscriptions and justified pricing across the region. Without them, the cable value proposition breaks. And when the value breaks, customer churn, where customers steadily cut the cord, cancel subscriptions, and don't come back, accelerates. This transition is occurring at the weakest financial moment for the industry. Caribbean cable markets are highly concentrated, dominated by Flow and Digicel. As a result, the revenue shock from Hurricane Melissa in Jamaica, and to a lesser extent the Bahamas, has weakened balance sheets across the wider region. That shock landed on top of pre-existing pressures: streaming substitution, IPV competition, rising content fees, and declining advertising revenue. The reality is stark. Most Caribbean cable providers do not currently have the liquidity or borrowing headroom to absorb ATSC 3.0 upgrades. This turns modernization risk into an operational risk. Under normal circumstances, government might cushion a transition of this scale, but that option does not exist. Across the Caribbean, debt dynamics remain tight. Several economies are still recovering from natural disasters, the COVID shock, or both. There is no fiscal space for subsidies, broad tax incentives, or large sovereign guarantees. This creates a rare and dangerous alignment. The private sector cannot invest and governments cannot intervene while the technology timetable continues to advance. If cable providers lose access to major U.S. networks, households migrate to streaming, IPTV and gray market services expand, and smart TVs bypass cable entirely. In other markets, similar disruptions have triggered a 8 to 15% subscriber churn within a year. In the Caribbean, where cable is already fragile, the impact could be higher. And critically, churn at this stage is structural, not cyclical. Once customers leave, they do not come back. At this point, cable can no longer be viewed simply as an entertainment service. It remains part of the region's information infrastructure, supporting emergency communication, education, public information, and election coverage. When foundational broadcast access erodes, the issue shifts from commercial viability to resilience and governance. In that sense, ATSC 3.0 is not just a technology upgrade, it's an information security challenge. The region now faces a clear choice. If governments and regulators do nothing, the likely outcome is fragmented upgrades, accelerated churn, consolidation, and loss of control over information access. If the region acts collectively, alternatives emerge: coordinated negotiations, pooled procurement, regulatory alignment, and preservation of access without unsustainable fiscal exposure. Neither path is cost-free, but one preserves resilience, the other forfeits it. The future of Caribbean cable is being shaped by three forces: a technology transition it did not choose, a financial environment it cannot control, and a fiscal reality that leaves government unable to assist. This is one of those moments where delay in itself is a decision. The question is no longer whether cable will change, but whether the Caribbean manages that change deliberately or absorbs it by default. Now that's your CBR briefing. This is a 90-second market brief. In Guyana, $20 million white sugar refinery has been approved at the former Wales estate. The plant will produce 100,000 tons annually, positioning Guyana to supply up to half of CARICOM's refined sugar demand. In Jamaica, Guardian General has launched a Climate Guard, a CRIF-backed parametric microinsurance product offering rapid cash payouts after extreme weather. Separately, the government has created a tax-free disaster honorarium framework, allowing employers to provide up to $200,000 per employee tax-free through March of 2026. In Bermuda, households will see electricity rates fall by 7.6% in January following a base rate cut, while the economy posted 1.9% real GDP growth in 2024, led by international business and construction. In Trinidad and Tobago, the central bank is targeting a fully digital payment system by 2035, even as agriculture continues to contract under climate and cost pressures. In the Bahamas, regulators are moving towards a check-free system with a proposed $10,000 check cap, despite softer domestic credit. Meanwhile, Barbados has proposed a 2% minimum wage increase for 2026. St. Vincent will hold its first VAT-free shopping day on December 19, and Belize's tourism sector continues to hold firm despite U.S. disruptions. Now that's your market brief. I'm Joseph Cox. For more on Caribbean Business Review, look for us on YouTube and Spotify.
In a world of constant change, insight is your greatest asset. At Joseph Cox and Associates, we empower innovation across the Caribbean. Whatever your challenge, we can help. We're proudly customer-centric, offering bespoke solutions tailored to every partner. From innovation and digital transformation to leadership and policy, our services are designed to deliver lasting impact. We partner with leaders across sectors, from finance and government to energy, tech, and infrastructure, helping them navigate complexity with confidence. Our work is grounded in collaboration. We connect regional leaders through powerful networks, driving change through joint research. Discover more at josephcox.org. Joseph Cox and Associates. Insight, experience, impact.
Still ahead on Caribbean Business Review, our conversation with Dr. Delreo Newman, chairman of the Caribbean Association of National Telecommunication Organizations, CANTO, as we discuss the Caribbean telecoms crisis.
Big tech, that is the Googles, the Facebooks of the world, you are operating on our network. And we believe you should be contributing something to that network. So in a 2023 study done by Strand Consulting, we spend, just for maintenance throughout the Caribbean, we spend something of the order of $500 million a year just to keep up. Do you know how much they extract from the Caribbean per year? Almost $11.5 billion US dollars per year.
Okay, welcome back to Caribbean Business Review. This is our strategy deep dive. And indeed, today, our very special guest is Dr. Delreo Newman. Now, he is the Executive Director, let me get it right, the Executive Director of International Regulatory and Government Affairs with the Atlantic Telenetwork International, that's ATNI, and he's also the Chairman of CANTO, which is the Caribbean Association of National Telecommunication Organizations. Now, in welcoming you to the program, Delreo, here is the challenge that I'm faced with. The global telecommunications market seems to be operating at two speeds. In one sense, in Europe, they're looking at 6G, and in Asia, they're looking at the framework for 7G, whereas we in the Caribbean, in a lot of markets, looking at we still have legacy arrangements with 2 and 3G, and you have some markets obviously with the 4G networks in place. Now the question is simply this: that we have long heard some of the networks arguing that there's not a business case for 5G in the Caribbean in the main, but at the same time the concern would be if we are looking at probably a 2 to 3 generational gap, as it were, in terms of telecommunications, what does this mean for our one, resilience, two, investment, and frankly speaking, the whole evolution of telecommunications and acceptance within the markets? How do we stack up, Delreo?
Well, first, let me thank you, Joseph, for having me on, and look forward to this discussion. As you know, the cliche saying, money talks, everything else walks. That's our reality. In part, as you know, the speed of technology is causing things to go so fast that whenever there's investment, by the time companies are to realize, first of all, there's the capex of getting that, and by the time
Right.
they realize any kind of return, then already a new generation of equipment is coming in. And unfortunately, throughout the Caribbean, we have some extremes. We have Bermuda. In one hand, income per capita of 120 or thereabouts US dollars, 120,000 US dollars
Right.
per year. And then we have places like Haiti, at which it is about $1,000 per year. So we have that great gap. And I think for a long time, we will be playing catch up. Part of the thing that we are now trying to do as we evolve to 5G is saying, look, to big tech, that is the Googles, the Facebooks of the world, you are operating on our network. And we believe you should be contributing something to that network. So in a 2023 study done by Strand Consulting, we spend, just for maintenance throughout the Caribbean, we spend something of the order of $500 million a year just to keep up. And do you know how much they extract from the Caribbean per year? Almost $11.5 billion US dollars per year they extract. So we are saying we would like something to be done, and the OTTs should be contributing to the upkeep of our network. Now, this is not anything novel we're talking about. We're looking at examples of South Korea doing the same thing, charging them. Australia have some mechanism. And as far as I'm concerned, when you look at Europe and how often they find the big tech for antitrust issues, they are making back that money. So that is part of the issue. The next issue I think of is part of our regulatory frameworks. Yes, a lot of times we say we are designing for investment, but again, throughout the Caribbean, from one regulatory situation to another, the type of regulatory framework that is involved is ex-ante regulations. Now, Europe have done away with ex-ante regulations because they realize there's another study a couple of years ago, I forget the name of the persons now, that basically said ex-ante regulation depresses GDP. And they did a calculation, and it was billions of dollars for Europe that happened, that their GDP was depressed because of ex-ante regulations. So again, we need to do a bit of catch up. We need to change some of our regulatory frameworks. And ideally, we would like some contributions from big tech to help fund and maintain the network in which they're using currently for free.
For free. All right, I hear you on that. But and what you're speaking about is what has been coined as a fair share conversation, as it were. But the question, I suppose the simplest question I could ask you where that is concerned, thus far, have they even acknowledged the thing, or are they willing to even have a conversation? I'm talking about the big networks now. That's on one level, and on the other level, is it that what the telecoms would be contemplating is charging additionally for probably usage of things like WhatsApp, um, the social media type things, Netflix, that sort of area that you have pinpointed as being major income drains. Because one of the realities that we know is that the average revenue per user, frankly speaking, across the region has been, I would say, flat. So within that context, what exactly has been the response so far? And politically, how is this likely to play out?
Well, for the most part, we are being guided by our big neighbor to the north, the United States.
Right.
2 years ago, when Brandon Carr, before he assumed the chairmanship of the FCC, he himself was very keen on saying big tech should contribute something. Now, one can think of many mechanisms in which this could be done. But the ideal one, and one that seemed to be getting some consensus, is through the USF, Universal Service Funding. So they would contribute to it. We are still, and that is CANTO, the industry organization for the Caribbean, is looking at certain mechanisms in which we could do this. Maybe a universal service fund set up by CANTO, and maybe depending on how much on a terabit usage, then that money would be distributed to each country accordingly. So that's one of the funding mechanisms that we're looking at. And right now, the whole idea of this fair share argument is within CARICOM and is being driven and spearheaded by Dickon Mitchell of Grenada. And behind that is Premier Burt of Bermuda. So they are both the spearheads and the deputy spearhead, for lack of a better word, at this time.
Man, I understand that, but you say I'm still looking at it because you say while you're speaking to about the Universal Service Fund and setting up one probably under the rubric of a CANTO as a catchment, one of the areas that we have long heard has been a challenge, as it were, for the telecommunications providers is that the spectrum fees are relatively high, right? And that has created the dynamic whereby one wonders whether or not, because, for example, as we transition to a 5G down the line, right? I would expect that you will have some more spectrum auctions and so on. No, the query would be, in terms of doing that, mechanism to encourage longer term investment in the marketplace. Is it that in the spectrum auctions where now the model is to try and get as much money as they can up front, do we need to tweak that to have basically a flatter type of investment engagement where it also encourages investment over the medium to longer term to really develop the market? Because Delreo, I'll be very honest with you, I'm very concerned that our competitiveness as a region is at serious risk if we don't step up our game.
I totally agree. I mean, in fact, you're speaking to the converted, and the whole idea of spectrum and spectrum fees in the part of the rubric of the regulatory framework. And unfortunately, governments have a bit of a tightrope to walk with this. Spectrum fees go into the general service fund, and that creates additional, revenue for the government for them to do other things with. I mean, ideally, we would love it to be that, they create more digital platforms and infrastructure stuff such as computers within schools, but again, as you know, I don't think there's a government out there in which they wouldn't like to have more revenues. And unfortunately, digital transformation and competitiveness is a little longer term, should I say, idea, and the return on that investment is a little longer term. And sometimes with governments, that don't immediately get you voted in for the next 4 years. So
No,
yes, you are right.
quite so because no, because quite so. I mean, because I'm looking at it and I'm saying, I am yet to see the politician who is going to look on the general public in whatever the jurisdiction they are and tell them that they want them to pay separately for WhatsApp. I think you'd have a political revolt. And I'm just being frank with you. I just don't see that as being a viable way. But at the same time, if you can get some contribution out of these large users, as it were, of your data, then I don't see why we would argue them. But at the same time, when we're looking at the argument about, because I remember at one stage we were hearing the conversations, there is no business case for 5G in the Caribbean. I noticed that Bermuda now has some elements of they have 5G. I just saw something the other day that Barbados is now going that way. And I know that Guyana had at least one firm offering their 5G service. So I'm wondering now, is the argument that there is no business case for 5G, does it still hold? Or what is it? Because honestly, if it can hold in Bermuda, if it can hold in Barbados, then I don't see why it wouldn't be able to hold when I say larger countries, I'm talking about larger in terms of population, like a Jamaica, a Trinidad, etc. So does that argument still hold? Can we reasonably look forward to a 5G service in the shortest possible time?
I would like to think somewhat it holds in that, of course, Bermuda and Barbados are all first world countries in terms of their income per capita. In terms of if a new operator, which is the one you're referring to in Ghana, is starting to build, so a greenfield build, then yes, it would be a 5G network. But again, as I said, money drives a lot of things. When you think that the average ARPU throughout the Caribbean, so of course everybody summed up, is something of the order of $10 per month, US, versus that of the USA, which is about $45. That in Europe is about the same thing. It's a little hard in terms of the investor putting in, building a 5G network when it has not recovered even the existing capital for the 3G and or 4G that they had just recently put in.
No, I hear you, but I mean, the honest truth of it is that we know that relatively speaking, our data charges in the region, I mean, frankly speaking, the companies make the bulk of the funds off data, right? So, I mean, even with the average revenue per user, as one of the things that we are trying to encourage companies to do, to basically teach people how to optimize the use of their phones. Correct? No, fine, you have a lot of people have a phone. But they honestly, and I'm not trying to be derogatory in any manner, but for the vast majority, they do not understand or appreciate the full capabilities of the instruments that they have. But while I'm saying that on the one hand, on the other hand, we're looking at a scenario whereby, yes, the average revenue per user is flat or, is low, relatively speaking. But at the same time, there are some other issues, I suppose, that will be brought to bear. And I mean, I look now just briefly at the Jamaican scenario, whereby they're just coming out of, or still in the midst of the rehabilitation from the recent Hurricane Melissa. But at the same time, Where the technology is now, as you transition from the 2 and 3G and going up the chain, you have things like the utility meters, the smart meters, that would have to be changed out, I would suspect, because a lot of those things would be working on the legacy technology. So in other words, there are vast opportunities, yes, in the new technology, but at the same time, we have to counterbalance it in terms of the investment in treating with some of these legacy instruments. And I'm just wondering where you guys sit in terms of this dynamic, because it really is a balancing act.
It certainly is. And again, I hear to do it like this. It is both for the regulatory frameworks to change and government policy to change in some instances. So, for example, again, in terms of write-off, the accounting rules, when you're told that it's 10 years or 20 years before, the traditional write-off versus allowing probably accelerated write-offs, things like that definitely would help. Something that you mentioned earlier, pricing spectrum. Yes, instead of looking to collect all of the money up front, maybe government should look to be partners with the operators. As I understand it now, for example, you mentioned, Melissa, a real challenge, and yes, it's working out well in situations like this. That is Elon Musk and his Starlink, and now that the things, the fiber and copper or whatever else is down, we have to look to satellites to help in that instance. But again, Elon Musk and Starlink do not employ anybody on the ground, do not pay any licensing fees, do not pay any regulatory fees. Well, they may, as I understand, pay something. But for the most part, their contribution to the economy is very small. Even if they do pay a licensing fee, even if they may pay a regulatory fee, relative to the other operators, i.e. a Digicel and a Cable and Wireless in Jamaica. So how do you balance, or how does a government go about balancing those competing interests? And I'm not going to sit here and tell you I have the answers, but that is the challenge both the government faces and the operator faces in trying to bring newer technologies.
Yeah, but then you see, Grant, you have just seen something whereby there's some debate apparently whether or not with the Starlink service in the Jamaican market, whether or not they have any more space for some residential plan or residential users. So there may be some constraints in terms of what is being rolled out. That's an aside. But for the more general question would be, would that type of market disruption not be the future, where, frankly speaking, you are likely to have others coming in with all sorts of different solutions into markets like these, using the satellites, etc., to really make that type of effective transition?
Well, yes, to a certain degree, it is a disruptor, in terms of, but if the governments continue to constrain cable and wireless and the Digicels in terms of forcing them to pay all these additional fees, then you are creating a asymmetric kind of market and giving a benefit or a leg up to the Starlinks of the world. Whereas, regardless of how good the system may become eventually, there's still latency issues associated with going out. Those constraints are not are not with what land network would be. So it's different things, and so I think while it can be disruptive, at the same time, if the policies of the government and the regulatory framework doesn't change, then we would be hampering competition in one area. So if we don't collect the same type of regulatory fees and licensing fees and use of the spectrum fees from Starlink as we would a Cable and Wireless and Digicel, then, as I said, why are we giving Starlink a leg up and we have these other legacy operators?
But then, help me with this. And I mean, I know you're not an engineer, but I'm just wondering to what extent can they, for example, infrastructure. I mean, in some parts that were damaged, and I don't want to harp on the Jamaican thing, but for some of the places that were damaged, it seemed to me that the telecommunications equipment was basically, you could call it a complete loss. It's a complete destruction. So, but what that raises for me to stave off the type of interventions like a Starlink, etc., it would seem to me that what you need to have is to the extent even feasible, more resilient infrastructure, right? That's one aspect of it. But then you raise the issue of the latency. And latency, as I understand, and they'll guide me with this because I'm a novice in these matters. Latency is basically the responsiveness of your equipment to things. So if you click on something, low latency means that you're basically going through relatively quickly. You're connecting quickly to whatever it is that you're clicking on, etc. But then at the same time, we all know that the telecommunications providers, even prior to, and this is a regional thing, if not even globally, frankly, that they throttle the speeds that you get over time. Yes, when you go, if you notice when you just pay a bill in the month, you're connecting quickly, blah 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 blah. As you go through the months, all of a sudden it gets slower and slower. We all know this. So I mean, these are realities that the people face day by day. So what is it then in this scenario that would avoid what we would call customer churn, meaning people just leaving particular companies and switching providers almost willy-nilly? What is it that we're used to this conversation going?
Well, there are
As
several
I say, I'm
things.
no expert, so forgive
Right,
me if
no,
I...
but there are several things that you mentioned.
Right.
Resilient infrastructure. All right. That is something that we are all grappling with as operators. Now, the Starlink, you just buy a piece of equipment, you come in, you turn it on, and you're good to go. The most expensive part of any for land-based operators is what is referred to generally the last mile. That is the connectivity between the equipment and the residential or the customer, whether resident or business. And that is not a cheap undertaking, in terms of building that out. And the more resilient you make it, is the more expensive it becomes.
Yeah.
So there's always this balancing act again, and being able to charge the customer in a manner that one makes the operator some monies, but also, being able to reinvest in that infrastructure. You also mentioned churn and customers moving willy-nilly. Well, I think you'll always have that because now that is driven by several things. I mean, customer service and how good an operator is. The idea of throttling, again, is a function of price you know, if you're using what did you pay for? You know, if you pay for unlimited service, you know, then you should have no throttling. And if you find that you are, then that should be something that you talk to your operator about and or move to another operator, you know, depending on how much you feel you're being throttled. That, again, as I said, is a function of pricing and how much people can afford. I'd rather slow you down than to lose you or tell you, well, you know, you have used up all your megabits of service that you paid for, you know. So again, all of this, yes, it is combined, but you have to be guided by what is it you're paying relative to, you know, the service you are getting. And as I said, customer service too from the operator.
No, but you see, I'm hearing in all of this now. It's not that I'm disagreeing with you, but you see, I'm wondering because as far as I would be aware, demand will drive a lot of things, right? So demand will drive usage, frankly. But as I alluded to before, if persons in the main are not aware, are not using the phones, well, most of us walk around with these instruments in our hands, right? And truthfully, these are not well, these are mini computers, honestly. Because in fact, in some cases, they're stronger than a lot of the laptops and desktops that people have. But what concerns me is that, for example, things like basic electronic commerce, that in this region, that is subpar, right? Is nowhere near. I mean, the irony of it is, for example, during the onset of COVID, a lot of people started to use they do e-commerce. But the irony of it is that the main beneficiaries of that electronic commerce were either United States, China, etc., or the UK and so on. Right? Those were the beneficiaries within the region in and of itself. We were not seeing it. In the main, Delreo, you know this better than I. A lot of the companies don't even have they don't have any websites. For a lot, they might have a Facebook page, right? But for the most of them, they have or if they have a static website, they don't have a dynamic website. So there is no, so in other words, they are limited in how we are treating with things. And this is where I'm going with this entire conversation, because it strikes me that one, you still have companies selling, even though looking to phase out, which I don't see any timeline for, but there's supposed to be a phase out of the 2 and 3G networks. But you do have companies still selling the equipment. That's one. And two, I'm worried because when you're looking at where the world is going and the opportunities that attend to the newer technology, we're spending top dollar for these instruments. They're not cheap. And we're spending top dollar for it. So it seems like there is a kind of dichotomy that is at play here that I'm not following. Because it's not the way we are shy in spending for the equipment. So what is the problem?
Well, you have alluded again to several things there. One, training, you know, educating our people on how best to use these instruments, educating our businesses, because
But
part
that
of
is the
the
company's responsibilities, I would think. The
right,
market, right.
right, no, but educating businesses in creating websites to sell their goods. Part of the challenge, it, you know, for us is knowing about and creating these again these websites in which to sell and 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 how best to do it. I was just thinking there was a project that came on many years ago, CKLN,
Oh,
and
yes.
yeah, and in which this was supposed to be linking all the universities and that we would be passing knowledge between ourselves, etc. And the main problem wasn't the infrastructure. We could create the infrastructure, but if we had nothing to put to sell, if we did not, if we did not put this information we have in a digital format, then that infrastructure, for all intent and purposes, become a clothesline. So it is transforming what we have in whether services or goods to a digitally related type product, so that we can exchange all of that.
Yeah. No, I hear you on that, and we have exactly 1 minute left. And the question really would be, for where you sit and for all we have discussed thus far, what would you see as the immediate imperatives over the medium term, over the next couple of 5 years, 3 to 5 years, to really move this market?
Oh, wow. I think I need a little more than a minute, but in terms of the things that we have to do is an investment that you have pointed out, creating resilience, right? And investment, when I say investment, not just in infrastructure, in platforms, in education, in training. I mean, it's a whole combination of things. And in addition to that, I'd also think getting the knowledge to protect our digital sovereignty, because that's another whole area that have come up. And I would venture to say Prime Minister Davis of the Bahamas, at the last CANTO conference, he spoke about this, because I don't know if you realize this, but if, for the most part, all of us generally store our information overseas in the cloud in the United States. And the United States made a law that basically says that digital information they can go into and look at it any way they feel like and do with it as they wish, including but not limited to not giving back the country that digital information. So we have a whole series of things that we need to do, and they all need to be prioritized at once, and that's just what I would say.
All right, fair enough. I mean, this I suspect, Delreo, honestly, is the first of many conversations on this area, because honestly, you have all sorts of things, because you have the cyber intrusions that are going on. You have this really antisocial behavior where people destroying the telecoms infrastructure to go sell copper and whatever. So,
Cyber security, and then AI is right behind that.
Exactly.
And we better get our act together. That is the Caribbean, because if we don't, we'll be left further behind.
Indeed, my friend. I thank you for that, and that's where we have to end it for today. So my thanks to Dr. Delreo Newman, who is the Executive Director of International Regulatory and Government Affairs with Atlantic Tele Network International, ATNI, and he's also chairman of CANTO, which CANTO is the Caribbean Association of National Telecommunication Organizations. Delreo, thank you so much, my brother.
Thank you, Joseph. Thank you for having me.
All the best to you. All righty.
Yeah.
In a world of constant change, insight is your greatest asset. At Joseph Cox and Associates, we empower innovation across the Caribbean. Whatever your challenge, we can help. We're proudly customer-centric, offering bespoke solutions tailored to every partner. From innovation and digital transformation to leadership and policy, our services are designed to deliver lasting impact. We partner with leaders across sectors, from finance and government to energy, tech, and infrastructure, helping them navigate complexity with confidence. us. Our work is grounded in collaboration. We connect regional leaders through powerful networks, driving change through joint research. Discover more at josephcox.org. Joseph Cox and Associates. Insight, experience, impact.
This is Market Watch. I'm Joseph Cox. We begin in Bermuda, where households will see electricity bills fall from January 1 after the regulatory authority approved a 10.5% reduction in base rates, translating into an overall 7.6% cut in retail electricity prices. The decision reflects efficiency gains and stronger than expected electricity sales. In Cayman, the utility regulator OFREG has finally moved to strengthen consumer protections in the ICT sector, issuing a draft framework to replace voluntary guidelines with enforceable rules. The proposal focuses on billing transparency, contract fairness, dispute resolution timeline, and service quality standards. Turning to Trinidad and Tobago, the central bank has outlined plans to transition to a fully digital payment system by 2035. A 2026 to 2030 roadmap includes new payments legislation, UPI-style instant payments, pilots for CARICOM payment and settlement system, and exploration of regulated stablecoins and asset tokenization, with cybersecurity and financial inclusion central to the strategy. In Guyana, a $20 million white sugar refinery will be built at the former Wales estate through a joint venture between Geico Construction and US-based Sucro Limited, with construction set to begin in January 2026. The plant will refine 100,000 tons of white sugar annually, directly targeting the CARICOM market, which currently imports roughly 200,000 tons, valued at $180 million. In Barbados, the government has given notice of its intention to raise the national minimum wage by 2% effective January 21, 2026. If approved, the hourly minimum wage would rise from $10.50 to $10.71, while the wage for security guards would move from $11.43 to $11.66. The public consultation window remains open until mid-January. Now, in Jamaica, passenger traffic at Sangster International Airport plunged 73% in November, as roughly 70% of hotel capacity remained offline. By contrast, Kingston's Norman Manley International Airport recorded modest growth, and Jamaica has retained all 29 airlines and 48 destinations, with new winter routes expected to support a gradual recovery. The Jamaican government has also approved amendments to the Income Tax Act, allowing employers to pay tax-free disaster honoraria of up to $200,000 per employee through March 2026, aimed at supporting household recovery and boosting short-term consumption. Finally, in the Bahamas, the central bank is pushing towards a check-free financial system, proposing a $10,000 cap on checks values while strengthening digital payment neutrality across legislation. Despite softer domestic credit growth in Q3, banking sector liquidity has improved sharply, with free cash reserves nearly 190% above the statutory minimum. Before we wrap, here's a quick look at regional currencies and market performance. CARICOM exchange rates remain broadly stable, with the Bahamas, Barbados, and Belize maintaining their long-standing pegs, while Jamaica trades at $160.92 to the US dollar, Trinidad at $6.78, Suriname at $38.78, and Guyana at 218 to 1. Haiti's gourd traded at $131.55. Across the Caribbean stock markets, the JSE index gained 1.16%, while the All TNT index slipped 0.44%. BSC, BSX, and BISX and ECSC remained relatively flat. Top gainers this week were Sagicor Real Estate X-Fund up 24.6%, and JMMB up 9.6%. Top losers were 138 Student Living Variable Preference, down 12.4%, and Palace Amusement, down 10.2%. Now that's it for your Market Watch. I'm Joseph Cox. Global Pulse is up next. This is CBR. This is Global Pulse. I'm Joseph Cox. We begin in China, where exports rose 5.9% in November, lifting China's January to November trade surplus to a record $1.08 trillion US, the first time it has crossed the $1 trillion mark. Shipments to the United States plunged nearly 29%, but exporters rerouted goods to other markets, helped by deflation-driven price competitiveness. Imports grew just 1.9%, underscoring weak domestic demand. The IMF has also upgraded China's growth outlook for 2025 and 2026. Staying in Asia, South Korea will scrap a 26-year-old rule requiring designated remittance banks and raise the no documentation overseas transfer limit to $100,000 US across all institutions. A new real-time monitoring system launches in January to curb abuse. Turning to Europe, Germany's industrial output jumped 1.8% in October, led by construction and machinery. At the EU level, Brussels will impose a €3 levy on low-value parcels under €150 from July 2026, targeting platforms like Temu and Shein amid an explosion in small package imports now averaging 12 million parcels per day. The United Kingdom, the Financial Conduct Authority has outlined reforms to channel pension savings into higher risk assets like infrastructure, private firms, and green energy, while fast-tracking IPOs and easing mortgage approval rules. Turning to the United States, the Federal Reserve cut rates again to 3.6%, but signaled a likely pause, with officials projecting just one cut in 2026. Inflation remains elevated at 2.8%, while unemployment has risen to 4.4%. Labor costs are cooling. The Employment Cost Index rose 3.5% year-on-year, the slowest pace since 2021. On energy, OPEC sees a far tighter market than other forecasters. OPEC Plus output in November stood at 43.06 million barrels per day, just 60,000 barrels above projected 2026 demand, sharply contradicting the IEA's forecast of a sizable global glut. The group plans to pause production hikes in early 2026, maintaining its view that the global economy remains on solid footing. Finally, developing countries paid $741 billion US more in debt servicing than they received in new financing between 2022 and 2024. The widest gap in half a century. Total external debt hit $8.9 trillion US, with interest payments alone reaching a record $415 billion US. Before we close, a quick look at global markets and energy. Oil prices edged lower, with West Texas Intermediate near $57.50 per barrel, Brent around $61 US, and natural gas down 3%, reflecting soft demand expectations despite OPEC's warnings of a tight 2026 supply balance. Equity markets were mixed. U.S. stocks retreated, with the S&P 500 down just over 1% and the Nasdaq off nearly 1.7% as rate uncertainty weighed on tech. Europe also slipped modestly while Asia outperformed. Japan's Nikkei jumped 1.4% and Hong Kong's Hang Seng gained 1.8%, supported by policy optimism and capital rotation. Now that's Global Pulse for this week. I'm Joseph Cox. This is CBR. Well, that's a wrap on episode 14 of season 2 of the Caribbean Business Review. Now, thank you to our loyal audience across MKR Radio and all digital platforms for your continued support. As always, we live by our mantra that knowledge is strength, but information is power. We wish to extend our profound thanks to Dr. Delreo Newman, Chairman of CANTO and Executive Director of International Regulatory and Government Affairs with Atlantic Telenetwork International, who provided invaluable insights on the current state of telecommunications in the Caribbean, highlighting the significant gap between the regions and global advancements in technology such as 5G and 6G. Now, some of the key takeaways were 1. The Caribbean's telecoms challenge is structural, not temporary. High costs, outdated regulation, and low returns are slowing the shift to next-generation networks. 2. The investment model must change, with big tech contributing fairly to the networks they depend on and stronger focus on digital sovereignty and resilience. And 3. Future readiness will depend on regulatory reform, resilient infrastructure, and investing in people and not just technology. Please remember our new CBR Intelligence Notes are released every Wednesday, providing deeper midweek analysis on the biggest economic and policy issues across the region. You can also listen to this broadcast at your convenience on Spotify. The latest edition of Caribbean Financial Dispatch is live on LinkedIn, WhatsApp, and linked in the YouTube comments. To subscribe, email us at caribbeanbusinessreview@gmail.com. Don't forget to like, share, comment, and subscribe, and follow Caribbean Business Review on TikTok, Spotify, YouTube, Instagram, X, and LinkedIn. Until next week, same time, same place, I'm Joseph Cox, and this has been CBR.